Hi everyone, I'm AJ Singh, CPA and enrolled agent from G&S Accountancy. Today I'm going to go over some of the tax law changes and how we help our clients in tax planning and all the benefits that we provide. So I'm going to get right into it. So energy credits will expire. Vehicle clean energy credits such as the $7,500 and $4,000 for new and used respectively will go away at the end of September. Home energy credits like solar that will expire by the end of the year, and the EV charging station incentive to build those out, those will expire next year in June 2026, along with the commercial energy improvements deduction under Section 179D. These are all going away. The depreciation limits for Section 179 are doubling pretty much. 100% bonus depreciation. For example, if you buy equipment, furniture, including vehicles as well, certain vehicles, you will get these deductions. Incentives for manufacturing, 100% write-off. 100% bonus depreciation is here for solar and wind. Going along with the theme of moving away from green energy, the depreciation, the regular depreciation called maker's depreciation, that is now getting longer from 5 years to 20 years. There is an underlying theme of not liking green energy. Welcome news for many companies is the research and development credits and deductions, the changes that have happened over here. The big one is for domestic R&D. For example, those of you who are developing apps and other process improvements in your businesses, the R&D expense is deductible now, whereas before it was amortized over a number of years. Foreign R&D is still amortized over 15 years. So the big one for this is how we help our clients. So how we help our clients with the R&D credits and deductions is that we see how your state conforms to the new rules, tracking what expenses will qualify, because not all expenses that you think qualify will qualify for this. Making sure the documentation is correct so you can substantiate the deductions. Going back to make a retroactive amendment has become a lot easier as well, so you can go back a couple of years and apply these rules to your previous two returns. So we're getting a lot of interest in getting that done for people that want to go back and take the deduction. And you can take the deduction and the credit, but there are certain rules on how to do that. And we're helping our clients do this correctly because this is a highly scrutinized area by the IRS. So we will help our clients project their taxable income before they make these investments, because you need to know what your taxable income is going to be. So how G&S helps with all these credits and deductions, we will see if you need them. We will project out your taxable income for the current year, 2025, and future years. We will look at the potential technology improvements, and we will cash flow your business with the investment. And if you don't make the investment or you delay the investment until the technology improves. And of course, we will make sure your paperwork is correct, especially for credits and deductions like the research and development. So who will actually benefit from this? Well, if you are about to make big capital expenditures or you have a research and development program in your business, then we can definitely help you. The real estate entities that are trying to implement the Section 179D deduction for commercial energy improvements, and we will review your business entity type and make sure that the credits, deductions, or both are maximized on your business, because the credits will be passed through on a S Corp or a partnership return, for example, and the C Corporation pays its own taxes. So credits will offset the tax liability dollar for dollar, whereas the deductions will reduce your taxable income. We will review and see the maximum benefit for the type of entity you have and whether this will benefit you on your personal tax return or your business entity tax return. So upcoming deadlines for all our logistics clients, because we help a lot of trucking, the 2290 heavy highway use tax, which normally is on August 31st, due on August 31st, because of the Labor Day weekend, it's going to be September 2nd. So we should start reviewing your units that you have in service as of July. And the 2290 is required every time you place a truck in service. So even if you've placed a unit in service mid-year, the tax return will be due the month after, along with the $550 per truck fee. Other due dates: September 15th is the due date for the extensions, so the entities that filed extensions for partnerships and S corporations. And October 15th is the due date for personal extensions and C corps. And of course, October, you'll also have other deadlines like your sales tax and payroll forms as well. We will help our clients with all of these deadlines, make sure that they meet the deadlines on time, and we'll do any tax planning necessary. And of course, we will focus our attention right now on 2025 tax planning. We have many clients that tell us they have negative cash flow, but cash flow is a reconciliation of balance sheet items. So the income statement is more where you go to see how much taxable income you might have. So it's really important to have good financial statements so that the projected tax liabilities can be computed, and then we can go ahead and implement all of the other strategies. Well, some of the strategies that I've mentioned. There are many other tax provisions that have changed in the last month, and we've only just reviewed some important ones. There are many tax provisions that changed last month, and so we will review those depending on the client situation and maximize the benefit.